Hello, everyone. Thank you very much for joining today's session for SESI members. My name is Nick Showen-Lambus, and I'm a financial advisor with Alpha Wealth. And I'm just going to talk today about helping you to kickstart 2024 and talking about certain things that I think we should all be doing to make ourselves as financially successful as possible, including certain areas such as auto-enrollment, which is something that's coming into play later on this year. I'm conscious that some of you maybe listen to this on recording, and a lot of what I'm going to say today is relevant for pretty much the whole of 2024. I've done a few sessions over the last few years with the SESI, but again, this will be available for online, and there is obviously the 1 hour of CPD. So I'm going to spend the next kind of 40 to 45 minutes just going through areas of personal finance. I'm joined today by my colleague, Cleena O'Donoghue, and we're basically going to go through a number of areas and certainly include any questions that you might have. And please do feel free to put any questions into the Q&A that we're happy to kind of give you any guidance and advice on, and we'll look to try and address them throughout the course of this. We have had a few questions over the course of the last few weeks, and Cleena might be looking to address them today. So as you can see, Alpha Wealth, we're an independent financial advisory company based primarily in Cork. We do have an office in Dublin. We have about 10 financial advisors, all of which are fully qualified with over 60 years of experience. I myself have worked as a financial planner for 25 years in Ireland. I was working previously in investment banking in London with an economics degree from the London School of Economics. So just in terms of what I'd like to try and, I suppose, enable you today, and really the main takeaways are helping you to plan successfully for 2024 and onwards. And really the main thing that I would suggest is making sure that you set out a financial roadmap. And what I mean by that is that based on where you are now, helping you to sort of compartmentalize what you want to try and achieve over the short, medium and long term, and the best way in which to try and achieve that with the less stress and obviously hassle possible. So as you can see there, hopefully on the screen, it's about trying to set clear financial goals, which January, for anyone who's listening to this in the month of January 2024, is a really good time to do this. Creating a financial budgeter, if you don't use one already, a really simple exercise, which I'm going to touch on later on, and then helping you to achieve what we call financial independence. Doesn't necessarily mean retiring, but gives you the ability to not have to work, certainly not as much. And we talk now about this kind of phased approach to retirement. So for most people that we deal with, helping you to try and get there maybe before 60, but certainly as soon as possible, where you can start to phase yourself into, ease of, what you want to try and do in later years.
So Nick, before you move on there, I suppose with the cost of living increasing nearly year on year, how possible is it to achieve financial independence by 60, and how can you get there even before that?
I suppose in terms of, what I think people should do, and again, depending on where you are and what stage of the financial cycle, that may or may not be possible. But certainly for those people listening to the call who are in their sort of 30s and 40s, I think if you can have a proper plan, and this is where a financial advisor like Alpha Wealth can help, and check in and make sure that you look to adapt that each year, because things change. Sometimes I speak to people who haven't had a financial review for years, and I say to them, but every year it's really worthwhile checking where you are on that roadmap. What has changed? Are you in a better position perhaps than was anticipated? Did the funds that you have grow more than was expected? Did you make additional payments into your pension that will basically reduce time off your working life? Are you looking to pay down debt more aggressively, take advantage of better deposit rates, for example? So I think there's a lot that we can all do, and I'm going to talk through that as we go through. But the main starting point really is to set out your financial objectives, what is important to you. There's no point me telling people that they should be putting more into their pension scheme if their desire is to try and buy a property in the next few years and they have to place their focus on that in the short term, or indeed if you have children that you're looking to try and finance through third level education. So once that's done, the next stage, and really the most important thing I'd like everyone to take away from today, is do complete a financial budgeter. It's a really simple exercise. I know it sounds a bit mundane. It shouldn't take you more than 15, 20 minutes one evening. You can do it basically using Alpha Wealth's financial calculator, which has a nice little graphic showing you kind of where your money's being spent and in what proportion. My colleague Cleaner hopefully might be able to put it up there in the chat, which you can access. It's a free tool to use. And what it does is it basically allows you to see where you may be overspending. A lot of what we do as financial planners is helping you find the right balance. A lot of clients I talk to say that they're earning, 3,000-4,000 a month net. That may be with themselves and possibly with a partner. They may be receiving some money from the state through the likes of child allowance and so on. And that yet with the money that they spend, they can't see where the difference lies. And having looked at this for most of our clients, we can help them, assess how to best improve their situation. A lot of clients we come across spend too much on insurance, for example. We come across so many people that are basically paying way over the odds, and it's comparing like for like in areas such as house insurance, car insurance, life insurance, for example. And anyone who's taken out a mortgage would have been forced to buy mortgage protection, most of which they would have been oversold. And typically I say to people as a general rule of thumb, you shouldn't be paying more than 25 euros a month. And if you are, do speak to us and I can show you how we can help you. The next thing then is once you do that is to allow, and maybe again through advice and providing independent advice, which we give you, or use your own financial broker if you have one, to set out what I call a menu board. How can you utilize the budgeter and take advantage of opportunities? For example, I'm going to talk briefly about pensions. Pensions are a really tax-effective long-term savings plan, really complicated by industry, but certainly for everyone that's listened to this, whether it's yourself or indeed your partner, particularly if you're paying tax at the high rate, generally if you're earning over 42,000 a year from January 2024, you should be looking to take advantage of this really tax-efficient regime. Savings, most of us got so used to earning nothing from the banks that we kind of lost sense of the fact that now, because of the rise in interest rates, you can achieve 4% from the banks of instant access savings that you may have in an account. I was talking to some clients earlier that asked me about how much should they keep in an emergency fund. And I said, very little. And they were sort of slightly surprised. A lot of advisors say you should keep 3 to 6 months of your monthly pay in an emergency fund. And I said to them, but you can put money into an account that you can access instantaneously, but earn 4% interest on that. And you might wonder, like, how can you earn 4%? And again, I'm going to touch on that as we go through this. For those of you that are high rate taxpayers, you can get tax relief on an investment of up to 50% this year. And many of you may not be familiar with the scheme, but I'm going to touch on it later. It's called the Employment Investment Incentive Scheme, or EIIS. And it's really worthwhile understanding and knowing that. A lot of us have debt. A lot of us have a mortgage. We may have taken out a car loan. We may have a credit card bill that, goes into month after month. And these things are just part of life. We've all suffered a cost of living increase over the last few years. And it's about helping you to navigate and best mitigate against the debt that you have. And I talk about something called snowballing, which is basically paying off debt as quickly as possible, utilizing the smallest loan that you have and paying it off as aggressively as you can, and then going on to the next loan and so on. Typically, your mortgage is your biggest loan. You leave that to last. But I can help you understand and reduce the cost of debt, including your mortgage and any other loans that you may have. I then talk about, like, what's your magic number? And what I mean by that is that we help all of the people that we deal with find out where they are now, but also where they're looking to get to. So for example, I'm 50 years of age. I have a very focused goal on achieving financial independence by the time I'm 63. Specifically, the reason for that age is that I have a 9-year-old and it's bringing them to an age of obviously 22. And what I'm trying to do is basically build up enough provisions to allow each of my children, and indeed myself and my wife, to get to a point where it wouldn't be necessary for either of us to work. Typically, for most people, and primarily your pension is going to be the biggest asset that you're going to accumulate to enable you to do that. I talk about a figure of about 800,000 euros, either as an individual or possibly collectively. And again, I'll touch on that as we go through this. So starting with the compartmentalization, I think this is really important. Whenever I talk to clients about their money, I ask them about the timeframes in which their money goes into. And sorry, the slide's got a little bit disjointed there, but we talk about short term, which is 0 to 3 years, medium term, which is 3 years to your age of independence, which depending on how old you are, let's say you're 40, that might be, say, 20 years when you look to try and achieve that time. And then long term is obviously your kind of retirement years, or again, it might be kind of this semi-retirement that a lot of us are doing now, where we work less hours or do a less stressful job, for example.
And Nick,
So
where is a good place to save on a short-term basis at the moment? I suppose, given that banks weren't giving any, it was 0% interest really up until now. So where's the best place now to put money on a short-term basis?
yes, this is a really good question. And again, for anyone who's just joined the call, please do feel free to put any questions into the Q&A. We are going to look to address them either on the call, or we can certainly deal with them separately. And I will give you my contact details if you'd like to email me directly. And you can contact me at any stage. There's no cost to any guidance that we're going to give you. Basically, the best account for monthly short-term savings, if anyone's saving to buy a car next year, if anyone's saving to buy a house within the next 3 years, or pay for their holiday later this year, you should take advantage of the online savings accounts with the likes of AIB, Bank of Ireland, paying 3% gross. You'll net 2% with the dirt tax deducted, which is roughly 33%. That's the best of type, and it's very, very easy to set up. It doesn't matter if you don't bank with AIB or Bank of Ireland, you can avail of those accounts very easily. And that includes really this emergency fund, as I mentioned. However, if you have a lump sum, so say, for example, you've built up some savings that's not working for you, it's sitting in a bank or credit union or post office, and I'm not particularly fond of the credit union and post office accounts because they haven't fallen into line increasing the deposit interest that they pay. But you can earn up to 4.25%. And it might surprise you to see that number. These are accounts, these interest rates are available in online banks within Europe, typically provided through the likes of Raisin and Trade Republic. Some of you may not have heard of those banks. They're completely bona fide, EU regulated, with governance, which is in excess of the Irish government guarantee scheme. But you can get and take advantage of much more attractive rates. And we think we all know that the Irish banks are not particularly competitive. And these German banks particularly have opened their doors to Irish depositors. And certainly I can send you information on this if you require. But Trade Republic, for example, you can get 4% instantly accessible monies. It's an absolute no-brainer for people who have short-term requirements for their cash. This is a good illustration of showing you the difference and why it's so important to look at getting interest on your money, particularly with this concept of compounding interest. Einstein spoke about, how powerful it was, and it really is, particularly over a longer period, but even over a relatively short term. So let's say, for example, you're saving €1,000 a month. The difference of earning 3% gross versus 1% over that 3-year period is about €1,000. You can see there on the top half of the screen, €1,000 that nets at 2% a year, generates about 37,500 at the end of the 3 years. If you only get 1% from your bank, giving you a net return of 0.67, you'll lose €1,000 over the same period. It's just throwing money away. If you had 20,000 currently in the bank, and again, you took advantage of the best online accounts available, you will generate a return to yourself net of about 21,800. If you earned 2% in one of the Irish banks, which is the best account interest available, you would lose €1,000 again. So collectively between those two accounts, on those sort of generally moderate sums, you're giving away €2,000 of net money that you could benefit from. I'm now just going to talk about medium term. And that sort of typically encapsulates, obviously, anyone who wants to buy a house in the next 5 years. It might be upgrading the house you have. It might be buying your first home. It might be looking to try and buy a holiday home, for example, or an investment property. And it's about trying to sort of siphon money into an account that's going to give you a potentially greater return. And it's this compounding effect that I mentioned earlier. And obviously, over a longer period, it's much more significant than the €1,000 that I mentioned. And typically, you should be looking for returns of about 5 to 6% per year for anything for 3 years and above. And this obviously would fall into things like buying a new car every 4 to 5 years, or indeed helping finance third level education for your children. This works extremely well for that purpose, especially if you have children who are in the kind of the single digit years. The chart that you can see on the screen, the colored chart, I think is a really powerful concept, again, as one of the takeaways from today, whereby you can recognize that if you need money short term, you cannot accept risk, and therefore you're defined by these lower interest accounts. If you're putting money into your pension scheme, regardless of your risk tolerance, if you've got time, and again, 10 years plus, you should be taking a fairly high level of risk, typically in the risk profile of 5, 6 typically. Why? Because you can afford in the short term to have a reduction on your interest. You can lose money, maybe 5, 10% in any given year. And whilst that may concern individuals, when you're in your early years, the reality is you're going to make a lot more money and accumulate a lot more positive interest over that 10, 20-year time frame. And again, as an independent broker with no bias, we can show you how you can really benefit from these types of accounts. Typically for those 3 to 10, 15-year period, most clients that we deal with, we're suggesting somewhere around the middle, where you can earn between 5 and 10% per annum, and consistently the best accounts of these types generate that. If you have a lump sum of money, say for example, you've got 5, 10,000 euros in a bank account, and you don't need access to that money for 4 to 5 years, there is a government scheme I touched on earlier called the Employment Investment Incentive Scheme. And you can earn a rebate of tax that you pay in this year of somewhere between 20 and 50%. We generally offer this scheme at 35% to 50% to our clients. Specifically, what does that mean? So there's about 70 companies in Ireland that look for finance from personal individuals. If Nick puts 10,000 euros into this qualifying scheme and he can choose the company that he invests in, I will get back 3,500 to 5,000 euros pretty much immediately from the tax I pay this year. And at the end of 4 to 5 years, I expect my 10,000 euros back plus interest. And I can show you a bit more information about the specific companies that we would recommend as an independent broker to individuals that are interested and in a position to do this.
Sorry, Nick, just before you move on, in terms of medium-term savings, the illustration you gave earlier was €1,000 a month.
Yeah.
What is the lowest amount that you can save on a monthly basis into an account such as this that you've illustrated?
So we show clients the variety of options available. We have agencies with over 11 insurance providers. Generally speaking, Zurich would be one of our preferred providers currently. They've shown outperformance, which I'm going to touch on later on, where you can save from a minimum of €100 a month up to 5,000 a month. And that can be done in a company or personally, and indeed, obviously, in a pension scheme, where that money will accumulate. You can stop paying into it. If it's a personal account or a company account, it can be accessed at any time without penalties, and there's no entry costs. And they are really useful and attractive. And as I say, I'll talk a little bit more about that in a moment. Finally, on the long-term goals. So again, don't get fixated about the jargon of pensions and different types of pensions and so on. All I'm suggesting that people should consider now is, do you know what and when you're looking to take life easier, work less, maybe retire? When is that for you? You know, I said to you, for me, it's 63, it's 13 years from now. And what amount do you believe that you need? And again, this may be with some advice and guidance. And where are you likely to be based on your current trajectory? So for example, if you said to me, Nick, okay, you know, what are you saying? I believe that for an individual in Ireland, you need to try and generate a fund independent of the state pension, which pays from age 66, currently about 13,500 euros to you, which very few of us could live on. That you should have a fund of at least about 400,000, primarily made up of a pension, could be made up of other assets you have, including investment property. Why? Because if you have that, if it's in a pension scheme, you can draw 100,000 of that tax-free, that's your quarter, and the 300,000 that remains will give you an income of about 24,000 per annum, including the state pension from age 66. That would be a reasonable amount, I believe, to sustain a sufficient income in your retirement. Now, obviously, that can vary depending on whether you have a dependence to support, or indeed, if you want to have a much more kind of lavish retirement than, you know, just you know, giving yourself the ability to maybe go on more holidays. The figure on the screen there, 2.15 million, that's currently the best pension fund that any of us can avail of in Ireland. You cannot exceed that. The tax on, if you do, is penal. Now, it may seem like a really large figure to some of you, but some people who have worked in companies for many years, particularly if you're a company owner, you could find yourself getting to that level by virtue of just the long-term contributions that you make. Business owners can pay 100, 300,000 a year if the company had the money to afford them. And there's no limit to what they can put into their money based on the tax changes that affected last year in 2023. So it's more a case of you knowing where you're likely to end up and doing the best you can with the ability that you have. So this is just an example. Again, I've used myself. I've given myself the opportunity of going back in time. So this is me at 40 with a fund in my pension of 100,000. And it's showing the fact that over time, and the retirement age that I set back then was 55 years of age. Obviously, I've had to adapt that. And that's the important reason why I say to you about having that annual review, check in and see what has changed. And therefore, you can see that basically with a contribution level of €1,000 a month, which is fairly moderate given the fact that depending on how much you're earning, it's all about trying to reduce the tax you pay. In my situation, obviously my company was paying in 500 a month. I was paying 500 a month. And because I'm a high rate taxpayer, I get €200 automatically back from the taxman. So my net cost is 300 a month. And because of the 15-year time frame, with a reasonable low assumption of growth of 6% per annum, it was going to generate a fund of about €1 million for me, which is significant. With basically the inflation rate, which I'm assuming at approximately 3% a year, that was going to bring my fund in today's money just shy of 800,000, which is typically the sweet spot for pensions. I won't go into detail why, but as a general rule, once you get to 400,000, the next stage you should look for is 800,000, because that gives you the maximum amount that you can take out your pension tax-free. I won't go into the main advantages of pensions, but again, you can see some of those on the screen. They really are very tax efficient. Company owners I've touched on earlier. If you're working as a owner, as a senior manager even, you don't even have to be the owner of the business. You can pay as much as a company will allow. So for example, let's say you're working for a company and you're on a salary of 100,000 a year, and you have a pension contribution of 5% of your salary from the company. The company could potentially, if you were able to agree with the company to say, pay a bonus into your pension scheme instead. It's good for the company. They don't pay employers PRSI on it. Good for you. You don't pay 51% tax on it. If you were able to live off 80,000 a year, under the new rules that came into effect last year, you could basically cut your salary down to 80,000 and have the additional 20,000 paid into a pension. It really is much more tax effective. And pensions, by the way, can be accessed from age 50. And if anyone has a pension scheme from a previous employment, and obviously some of us have changed jobs more than once in our careers, you can utilize those pensions earlier. So it might enable you to pay down debt quicker. It might enable you to buy an investment property or indeed fund your kids' education. And it's worth getting advice from a financial broker and showing you how you can manage that. People talk about amalgamating pensions. It generally is a bad idea, but it doesn't mean that you shouldn't have your pensions managed for you. So if you've worked for a company, let's say, you worked for PM Group 5 years ago and had a pension fund worth 50,000 and you joined a new company, it's really worth knowing, like, where is that company invested, that pension scheme? What is the plan in terms of what are you going to utilize, and getting that projection done specifically for you? Again, I won't go into major detail with you here, but you can see here that even for company owners that have retired and drawn a pension scheme, the new rules allow the fact that if they've taken up employment or if they're still working, they can pay more money into a pension scheme and basically draw benefits down very tax efficiently again from that. Really, really good opportunity. Some of you may have heard that there's something called auto enrollment coming into effect in 2024. It looks like it's going to be September the 1st, 2024. The relevance of this is that if you employ anybody, you're going to have a pension scheme paid by the company for that individual if they're 23 or over and earning over 20,000 a year. Say, for example, you set up a company a few years ago and you employ one person in addition to yourself and possibly your partner. You will have to pay into a pension scheme under this new auto enrollment regime. I am really not a big fan of auto enrollment. I did a webinar on this last week, and if anyone wants to see the webinar, we're happy to share it with you. You can access our webinars, both upcoming ones. I'm doing one on the 22nd of February in relation to 5 key tips to be financially successful. I think it's really useful, and I might touch on it later, but Cleaner can put it into the chat function for anyone that's interested in either attending the webinar or getting the video after the event. You can go back and look at some of the previous webinars that I did. I did one last Friday, which was on the 12th of January, and it was a really kind of good synopsis of the areas that I'm covering today, going into maybe a little bit more detail over half an hour on some topics. And also I did one on auto enrollment, as I mentioned. Why am I not a big fan of auto enrollment? Because you might say, Nick, but this is allowing our employee to have, contribution. Or if you work for a company, you don't have a pension scheme, you may feel good about the fact the company is going to have to pay at least 1.5% of your salary into a pension. The problem with auto enrolled schemes is that it allows for no flexibility. You cannot change the payment. You can't pay more than 1.5%, and your employer cannot either. It allows for no early access. You can only draw this pension down from age 66, which is currently the state pension age. Really not useful, particularly for what we said earlier about helping our clients retire early. The other issue with auto enrollment schemes is that there's no advice given and there's no choice. And I think that's really important. Everyone should be getting advice, preferably independent advice, on their pension scheme. Which provider is your pension with? How is your pension performing, and are we in the best fund for you? This is a very quick example for some to be, let's say, a company that employs 10 people. And you can see the significance of starting to kind of align yourself to the fact that if you have 10 employees and none of them are in a pension, you're going to be forced to pay about 6,500. And this is showing an example based on a salary roll from 30 to 50,000 odd, of around 6,500 a month, a year, which is increasing every 3 years. It's going to be 3% in 3 years' time, 4.5% in 6 years, and 6% in 9 years. The total cost of your company is going to be 144,000. You can imagine for companies that hire 20, 30 plus staff, how significant this is potentially going to be. And what I'm showing companies is that there is a better way. You set up your own pension scheme. You can set the level at either 1% of salary, 1.5% if you want to go in line with auto enrollment, You don't have to. And there's significant cost savings, not just now, but also in the future. And your employee is going to thank you for that, because it gives them that flexibility, gives them the ability to draw access early, and so on and so forth. There are so many advantages. I've put them up on the screen here. I won't go into huge detail. As I said, that's detailed in a webinar that I did a week ago that I would suggest that you may access. I've said earlier, not all pensions are the same. I often talk to people and say, yeah, I have a pension scheme, or I have a pension from previous employment. I'm okay. And I say to them, but where is the pension invested? Which provider is it with? You can move the provider at no cost. You can have someone manage it for you and make sure you're in the best fund possible. I said earlier that Zurich are our preferred provider. They have vastly outperformed their peers. And if you don't believe me, just look at this screen. You can see that on a comparative basis of funds, i.e. they're all in the same risk category from New Ireland, Standard Life, Irish Life, and Zurich. Zurich's Prisma 5 fund, which is the fund that we generally recommend for anyone in their 30s, 40s, and early 50s, has vastly outperformed, not just this year or last year, but over the last 5-10 years consistently. And it's really, important to recognize and to get guidance and advice on that. And I come across clients who say, yeah, but I'm coming close to retirement. I'm in a cash fund. And I say to them, but what's going to happen when you draw your pension benefit, when you effectively retire? You're going to take 25% of that, but the other 75% is going to remain invested. Why are you putting all your money into a cash fund? It really doesn't make sense. Pensions are for the rest of our lives. And if you pass, the pension passes to your next of kin and it passes to your dependents. So it's worth noting that these really are long-term effective vehicles for all of us.
But Nick, before you go on there, sorry, what if your company does not provide any guidance or contributions to your pension? Can you give a little bit of advice to somebody in that position?
Well, the good news this year is that they're going to have to provide at least the auto-enrolled scheme. Now, the auto-enrolled scheme, which will affect once the government decide, and they're going to make a decision on this in the next 2 to 4 weeks, but they've stated very clearly it will come into play. It might be even earlier than September. So I'm telling any people that employ an employee, get ready for this. Start to allow for it in terms of costs, but also you need to act before auto-enrollment happens, because what will happen is currently on the 1st of September, any employees not in a pension scheme are going to be forced into the auto-enrollment scheme. No choice given, no advice given, and there's going to be deduction from the company bank account to the pensions board. And companies that don't do this, by the way, there's going to be severe penalties. They've said that there's going to be really big fines or indeed imprisonment for all, company owners. So be very mindful of that. What can you do? As I say, get advice, get a pension scheme set up. Primarily, I would recommend with Zurich. We're a low-cost provider. We provide 100% allocation of client funds. It's really important to make sure that your fees are kept to a minimum. And obviously, it gives you the opportunity then to decide what do you want to do for your employee, because there is one advantage of this regime, which is that it may allow you to attract new staff because you're providing a pension scheme. And indeed, it may allow you to retain staff because obviously they're now getting a benefit. So the key point is, talk to an independent broker, get guidance and advice. Even if you have a pension scheme in place, some companies have already effected a pension, but not all their staff have joined the scheme. And that doesn't mean that you're okay. It means that those that are not joined will be auto-enrolled, and then you're going to have to send 2 pension payments, one to the current pension provider, and then the other to revenue. And the problem with that then is that it's very messy. You've got employees on different regimes. Those employees that are auto-enrolled won't get any advice. It's a good opportunity for you to check in and see where your current pension provider is in terms of fees, because a lot of these pensions have been set up with a 3 to 5% charge for all contributions. And that to me is unacceptable. If I was anybody that has a pension scheme, whether it's my own scheme or it's for an employee, if you're not getting 100% of the money invested, you're basically paying way too much. And it's really a time to say to yourselves, okay, it's good for me to get advice and see where I'm at.
Nick, sorry, now I have a few more questions, if you don't mind just addressing them
Absolutely.
first before you move on. So what percentage of your salary do you recommend to put into your pension?
10%. If you said to me
Okay.
as a rule of thumb, how much should I be contributing to my pension? My general rule of thumb is 10%. Why? If you're earning 50,000 a year, that's 5,000 euros gross. That's about 416 a month. And then you get tax relief for 40%, which costs you 250 euros a month. I think for someone earning 50,000 a year, that should be part of their financial plan. And I talk about save first, spend later. When you do that financial budget calculator, you should put down 250 euros into the pension box. It may not be possible for other reasons, but that's the aspiration, you know. And as I said, depending on where you are, it's about, you know, dovetailing other things that you want to do. Same with savings, you know, every one of us should save. We should be putting money away, but we may not be able to at the moment because maybe we're paying too much for our mortgage, or when we be paying too much for our insurances. And this goes back to obviously getting some independent advice. But it's not about, you know, you're saying, well, I can't afford to do this. Most clients I talk to can do what I'm asking them to, maybe not to the level of which I'm describing, but it's just about starting. Once you start something, it becomes more of a habit, and then you can make the adjustment to that. Okay.
And if your company already has a PRSA set up prior to auto enrollment, can you keep all the flexibility of the payments, etc., or do they have to change to keep in line with auto enrollment?
It's a really good question. As long as the company's making the contribution for all members, then the same scheme can prevail. The only problem then is, what are the costs of that PRSA? Because I can say to you now definitively, and I would ask all of you to check, the PRSAs that was set up prior to May of 2023 were all set up on a fee basis, i.e. you're paying 3 to 5% of all contributions. Because the tax rules changed last year, the providers have now introduced an arrangement where financial brokers can charge less, and not all of them are, by the way. I'd like you to see Alpha Wealth as a low-cost broker. Again, you don't have to use Alpha Wealth, but don't accept anything less than 100% allocation. So what I'm really saying to you now is, this is a really good time for us to kind of check in and see what are the fees. But the short answer to the question is yes, but I'm not sure would I stay on the same regime if I'm not getting the best fee possible for myself and all members. Just moving on, for companies as well, if you have 3 or more staff, one of the things I say to all companies is it's worth just exploring the option of adding death in service and possibly income protection to your members. Why? Because take, for example, Alpha Wealth, which is a company that I own alongside my partner. We have 10 employees. We provide a pension scheme based on a 3% contribution currently. So we're not going to be affected by auto enrollment. We've made it such that all members are joined the scheme. But we've also introduced death in service and income protection. Why? Because it's a really low cost benefit. It costs about 20% of the cost if you were to do this as an individual. Basically, it provides for every employee 4 times their salary paid if in the unfortunate event that they pass during their work tenure. Why is that relevant? Well, it's useful for the fact that you don't want to have to be dealing, obviously, with the tragic event. And obviously, it's nice to know that there are funds paid tax-free to obviously the state of the member, but also that for you as an individual who can be included, obviously, if you're the owner of the business, that you can benefit from maybe reducing the cost of other insurances that you're paying for unnecessarily. Same for income protection. It's a really useful, relatively cheap benefit. The great thing is that there's no medical forms required, unlike taking out insurance on your own volition. There's no forms, great flexibility, and it's definitely something that, because of the fact that pensions are now going to become mandatory for companies, it's worth just noting and being aware of. And again, we cost these for all companies and show you throughout all of the providers in the industry the lowest costs that can be taken advantage of. Just the last couple of things I just wanted to touch on before we may take more questions is, a lot of us don't claim back tax that we are entitled to. Michael McGrath made reference to this in the budget last year. said, there's so much money that's sitting in revenue that the government are trying to encourage individuals to take back. And these are typically things like anyone that rents. Over the last 2 years, you can claim back up to €750 a year, especially if you have a child perhaps that was renting also. They've just recently added that also in the budget. Anyone who worked at home during the COVID years, or indeed continues to work from home part-time or full-time, you can claim a percentage of your expenditures, particularly energy costs and phone bill. And again, most of us have just not done that yet. And there are other things that you can claim for. There's an extensive list which is on the Revenue Online system. And certainly for anyone who isn't using an accountant that is doing it for them, and make sure that your accountant, if you do have one, is doing this. But it's really easy to set up. I encourage everyone to do this. You can set it up and I can send you a step-by-step guide of how to do this. It takes 2 minutes and you can go back 4 years. And honestly, there are so many opportunities for all of us to claim back tax. And certainly, we talk about, improving your financial position. This is a really easy one in my view. And again, if anyone is interested, we can provide in more detail. Finally, I just wanted to mention for SESI members, we provide a full financial consultation. It's a once-off cost of €199. It encompasses many reviews and ongoing reviews, as I mentioned, on an ongoing basis. So over the next 5, 10, 15, 20 plus years, we will provide all advice based on the initial cost that the member makes. Essentially, the starting point would be to do a look and see of where you are now. What are your arrangements? What savings do you have? What loans do you have? And we put that together for you in a really tidy format. And then we show you how you can, plan effectively, referring to this roadmap that I spoke about, helping you to manage and I suppose achieve your financial objectives over the next 1, 2, 5, 10, 15 plus years. As I mentioned earlier, though, if anyone has any questions and wants to reach out to me and just to ask, obviously, anything that you want to do, I'm more than happy to do that. My email address, which you can use, and you can either go to info@alphawealth.ie, which is on the screen there, or nick@alphawealth.ie will get me. And you can ask me any questions on email, and I'm more than happy to answer them. There's no cost to you. But if you would like to undertake that review, typically over Zoom or Teams, or in person if in Cork and Dublin, and generally we can do that at a time and day that suits you, including evenings, and with a partner if it's appropriate. And you'll probably guess the starting point would be sending you the financial budget calculator, asking you to complete that. It's going to make the meeting a lot more meaningful. Going to ask a little bit more about your pension arrangements. You don't have to spend hours digging out information. I prefer you not to be honest. It's about you just giving me a sense of where you are. Like, do you have a pension scheme? Yes. If so, where is it held? Is it Irish Life? Is it with your present employer? What contributions are going in? And by virtue of those simple questions, I can start to do a kind of a projection for you and then show you how it can best be managed. I've put up on the screen there details of that next webinar that I'm doing, and it's available complimentary to everybody on the call. It's on Thursday, the 22nd of February at 1 o'clock. As I mentioned, if anyone can't make it but wants to get the video afterwards, just pop me an email, or you can register now by using the QR code that's on the screen. I think my colleague Cleaner has put up as well how to register for the event, which is free, and it will be very, very useful. I'm going to drill down on these, I call them 5 millionaire habits. We can all be millionaires, and I'm not saying that to be glib. Most of our pensions and our property that we've obviously we buy will provide that for us. And then it's a case of how we can best utilize that, because retirement is expensive. A lot of us are living longer now, and the desire really for a lot of us is trying to retire early. You've got maybe 20, 30 years to fund for. And then it might be a case of providing an asset to your next of kin and obviously to children. And really what I'm trying to do is help people grow their wealth. And that's really the mainstay of what we do in Alpha Wealth. I do really appreciate your time today. I'm conscious of time, and it brings us.
I have another question for you, Nick. Sorry, I'm just going to bring it up there. So is it correct that you can take out 100,000 out of your pension at the age of 50 without paying tax on the 100K?
Yes, potentially. If you have a pension fund of 400,000 euros from, say, a previous employer, and or with a current employer, and you decide that you want to cease employment with that employer, and your fund is 400,000, absolutely, you can take 25% of it tax free, which is 100,000. Depending on how many years you worked in that company, by the way, you may be able to draw more than that. If you worked for that company for 20 years and your salary was somewhere north of 50,000, you could avail of more than 25%. When you turn 60, of the remainder, which in this example is 300,000, the accumulated growth of that from age 50 to 60, you'll be required to draw a minimum of 4% of that. Now, that may sound really attractive to people. And a lot of people say to me, Nick, okay, well, yeah, I'll do that at 50. You know, I'm 52 now. Why don't I just access my pension? It isn't always the best thing to do, because if you think about it, one of the advantages of pensions is that they grow tax free. So if you take your 25%, that 100,000, you've given up the ability of that 100,000 to grow. And if you're still working, do you really need to access that money? You know, you've foregone a future benefit to yourself. Now, I'm not against people drawing pensions down. Let's say, for example, you have a pension from a previous employer that's worth 50,000 euros. You could take out 100% of that tax-free at 50. And that to me would be a much more useful opportunity where you could use that money effectively, not paying the tax man anything at all. And you might be able to then, you know, buy a property with that, you know, obviously helping you to achieve that, or helping your kids through college, or, you know, buying a car outright, paying down the increased cost of debt we've all witnessed. I haven't spoken about mortgages today, but if anyone has a mortgage, if you're on a tracker, I'd like to talk to you about your options. Obviously, tracker mortgages have become a lot less attractive than they were for so many years. If you're on a fixed rate mortgage, when is your fixed rate expiry coming up? You don't have to wait until it comes up. You can change it now. Is it worth talking to your current bank and getting a better rate? If you're with AIB, for example, and you're not on a green rate mortgage, you should consider whether you can apply for one. You may already be able to if you have a BR rating of B3 or higher. If you don't, what do you need to do to get there? Will save you a significant amount of money in the future with no real hassle. And we don't provide mortgages in Alpha Wealth. We give independent advice. We can help you. I can tell you what the best thing to do is. And then we obviously work independently in showing that you can get what you want to achieve done. Same with those
So
accounts that I mentioned earlier, the likes of Raisin, Trade Republic. Really easy to set up. You know, I can send you the links for them. We have no bias, but they are the ones that I would like you to take advantage of.
Nick, what if somebody has maybe an old company pension? They might have several old company pensions, or if they have a pension from working overseas, what would you suggest that somebody does with those? Should they consolidate them, or should they leave them all separately?
As I touched on earlier, generally the rule of thumb is to leave them separately, but you can utilize our services, and this is part of that financial consultation that I mentioned. And for that once-off fee, we will get details of all of those pensions for you. We'll do all the heavy lifting. We'll advise you on the most appropriate actions to take place, and we'll set out that financial plan. Generally, the reason for not amalgamating them all is that you lose the flexibility of drawing those pensions at different times. You know, if it was me, what I'm planning to do is I'm looking to draw benefits maybe from 60 onwards, where I can take this phased approach to retiring, and it just supplements the lesser income that I'm going to receive if I do that. But as I say, it's about getting advice in relation to working abroad. Anyone who worked in the UK for 3 years consecutively over the last 30 years, they should be buying back UK state pension years. You have until April 25 to apply for that, something I did recently myself. And you can buy them at a really low cost It's such a great benefit, and a lot of people who have worked in the UK are not doing this. And if you want to avail of that, email me and I'll send you the link of how to do that at no cost to you. If you've worked, say, in the Australia, for example, you may not know what's going on with your pension scheme if you left it there, the superannuation scheme. I can advise you on your options. It's not a good idea to transfer pensions to Ireland. Some financial brokers try to do that because they want to earn money from you. It's generally at your disadvantage. But it doesn't mean that you shouldn't be aware of what's going on with that pension, and then obviously having someone independently give you guidance around the totality of your pensions and the direction that you're going in. For a lot of the business owners, and if there is anyone that owns a business out there or partially owns a business, you should really make sure that you're aware of the rules that changed last year. You can employ a partner, pay them a salary of 10,000 a year, and put 100,000 a year into a pension for them. You can employ a child, same thing. You know, it really has opened up the floodgates in the opportunity for companies that are generating more cash than they're spending. And again, it may not be necessarily relevant today, but as part of this auto enrollment regime, it is something that I would suggest that you be considerate to.
And what about self-administered pensions, where you could consider maybe buying a property through your pension if the funds allow? Can you just give a little bit of insight into that as well, please?
Yeah, I mean, self-administered pensions are available to pretty much all of us if our company allows. So if you're the owner of the company, or if your company allows you the option of having one, or if you've worked for a company previously, let's say you have an Irish life pension, you work for a company for 10 years and it's worth 200,000 euros. That pension can be easily at no cost transferred to this self-administered scheme. Don't worry about the jargon, and it can allow you to buy a property with it. I've done it many, many times for clients over the last number of years. I've done it for myself even, and I can show you the best and easiest way to achieve that and give you proper advice around, you know, what the best thing for you is. It might not necessarily be that. I say to people, look, why are you looking to buy this property? Okay, it's a good investment for me. Okay, well, you don't need to do that and set it up until you find the property. So at least you can get growth on the pension fund before you know, push the button on it. But again, it's about getting advice and guidance as to what most might be most appropriate for you. And it might be something for the future. I pride Alpha Wealth on being an independent, full service broker. We can give you advice on health insurance. We don't provide health insurance, mortgages, pensions, as I've touched on, savings, and taking advantage of the best accounts, reducing debt, making sure you're paying the littlest possible on your insurances. It surprises people when I say to them, send me on details of your car and house insurance when they come up for renewal. And they often sort of query, what's in it for you? And I say, nothing. But we don't want you to pay a cent more than you should be. And a lot of us are time poor and we think we're shopping around well enough. And I say to them, but have you reached out to several brokers and let them verify, you know, what you're paying? I use two brokers for those insurances. One of them's in Cork, O'Leary's, and one of them's Stockton's in Dublin. And I find them to be the most competitive in most of those product areas that I've touched on.
So,
I
Nick,
do
I
really
suppose
appreciate your
just,
time. Sorry, go ahead.
oh yeah, no, I was just going to ask you, I said you've had a few articles in either the Business Post, the Sunday Times last week, giving kind of tips to kickstart 2024. Do you want to just finish off with maybe wrapping it up by
Yeah.
just giving some of the top
So
tips?
on some of those topics that I spoke about, you know, I spoke about auto enrollment. There were several articles that were published in the Sunday Business Post, which we can share with you. You know, and I'm not saying this to boast. It's just the fact that I'd like people to get advice and obviously then make informed decisions based on the advice and choices that they have. If any of you have children, I think there's a really great way of saving money, but doing it in a way that's more tax efficient for them. I have 4 children in a blended family. I feel very strongly that it's something that we should consider. You can only gift, or your children can inherit, up to 335,000 euros. That's a really penal tax system that we have here in Ireland for gifts or inheritances. We can share some of this information. And as I said, it's really about doing the best you can. Are you getting 4% from your bank? You're not. So you should be looking to take advantage of, you know, the product that I mentioned earlier to the likes of the banks I referred to. Obviously, as I say, if you're not saving for your child's education needs, I think it's something that we should build into your financial plan. May not be possible immediately. And a lot of people are saving into likes of the credit union and post office. And I really dislike those institutions for long-term savings. They don't pay interest that even meets inflation. You're basically just losing money by utilizing those accounts. And there are much, much better options out there. I appreciate there was a lot of what I said today, but again, we simplify it and we can make it very simple for you. But if you want to reach out to us, we can set out this plan. And if anyone does have questions, please do email me. As I said, info@alphawealth.ie or nick@alphawealth.ie will get me. The video is obviously going to be available to SCSI members. There is the 1 hour CPD. And as I say, I really would be happy to send on any information that anyone does require. And if you want to avail of the review that I mentioned, we can send you on information about how easy it is to set that up at a day and time that suits you. Really appreciate the opportunity from SCSI to do this webinar today in January 24. And again, we'd love to hear any feedback as well in terms of any topics or indeed any comments you might have on what I've covered today with you. Thank you very much again for Grace and the team at SCSI for making this possible. I'll finish